We might as well get started. So today's lecture, we're getting started with a new topic in the course, which is topic 3. Topic 3 is going to start to represent a shift in the mindset of this course. So far, our course has been predominantly qualitative, right? With the exception of unit economics, everything we've done is qualitative. Now, of course, you look at the unit economics problem on the homework and maybe it feels a little bit involved and it requires a bit of a challenge. But if you think about the amount of FaceTime we've had and what we've been discussing during our FaceTime, right? Really, for the most part, it's been us talking non-quantitatively, but hopefully logically about things that matter with startups over their life cycle and things that matter to investors and the people who devote their blood, sweat, and tears to startups when they're trying to figure whether or not a venture is worth it, right? But highly hinged on, I would say, logic as opposed to quantitative stuff. I mean, obviously quantitative stuff is logic as well, but it's kind of like a different kind of logic. Now we're shifting gears and it's literally like, it's almost like a 180-degree turn because most of the remainder of the course is going to be quantitative and we're shifting away from the qualitative. We'll still have some qualitative because we're always going to ask ourselves qualitatively, what assumptions are we making when we do this quantitative work? What's reasonable, what's not? So we're going to always try to exercise some discipline in thinking through that. But first and foremost, rest of the way is going to be involving some math almost every step of the way. Not rocket science, let's be clear, but nonetheless, for some people it's going to be a difficult switch. For some people it's going to be a welcome switch. That's fine, right? But all of this stuff is important, right? So we're going to be doing models, but the models are geared specifically to our application, so specifically to the startup context, specifically to the VC context, and it's stuff that does in some way, shape, or form get used in practice, okay? So that's kind of what we're doing now. Our quantitative parts are going to be split actually into 2 topics, topic 3 and topic 4. Topic 3 is going to be what I call quantitative decision-making or quantitative evaluation. Look, in plain English, what that means is we're going to think of answering the following question. How much is a startup worth? And when I mean how much is a startup worth, I don't mean how much is the startup's equity worth. I mean, what is the value of the whole startup as in its enterprise value? Now that tends to be a bit of a less necessary distinction with startups because startups have generally little to no debt. So that, enterprise value approximately is equity plus cash, right? But we'll be thinking about it that way. We'll be thinking about it as what is the value of that whole pie, okay? And we're gonna tackle this with both comps-based valuation approaches and DCF-based valuation approaches. And within comps-based valuation, you guys are gonna see that we're gonna introduce a variety of different ways to do comps valuation in this setting so that there's gonna be a lot more nuance and richness in the way we implement a comparables-based valuation in a startup context than what you may have seen in a context dealing with mature corporations. So for instance, what you may have seen in a course like ACF, if you've already taken that course. By the way, if you have not, do not panic. It's not necessary to know this in our course, right? But if you've taken that course, well, at least if you've taken it from me, you've definitely seen comps valuation. But you'll actually see that we're going to do more different versions of it here. In fact, there's going to be a specific reason for that. You guys might remember that I like the word life cycle, the life cycle of startups, the life cycle of funding, right? Well, I'm going to talk about the life cycle of valuation. And the reason why I'm going to talk about the life cycle of valuation is because the way you value a company really early stage is different from the way you do it kind of more mid stage, which is different than what you do more late stage. The way you do it evolves, and it's for a very basic reason. It's because the amount of information you have to value a company grows over time. When a startup is just a napkin and a dream, it's tough to do a detailed valuation. But as you reach product market fit, as you start showing some predictability in go-to-market fit, as you start scaling aggressively, the amount of data that we have, the amount of understanding of a market that we have grows and allows us to get more and more detailed with our valuations. And we want the tools that we discuss in the class to be able, we don't want to just have a knife, we want a Swiss Army knife that is like appropriate for all the different settings. And so I'm going to try to teach you guys as many blades in that Swiss Army knife as possible. And I'll try to pick the blades that I think are the most important. Okay, so topic 3 will be that. We'll talk about different comp space valuations, and I'll try to highlight the difference between a normal comp space valuation that you would see for a mature company in public markets and how it gets done differently in a startup context. And then we'll do the same thing with discounted cash flows. We'll talk about how we do DCF with a startup and why it's different when you look at the details of the formula from the way you would do DCF with a mature company. All right, so it's there, like what I'm going to really want you guys to get, if you really want to get the most that you can out of the topic, is you want to be able to use the tools, but you want to understand why the tools are different here than they are with mature companies. Make sense? That's topic 3. Topic 4, I'm just going to briefly describe it here because we'll talk about it again when we start topic 4. But topic 4 will be about what I call deal structuring. It's the agreement, the financial contract that a VC and a startup enter into when the VC invests in the startup. And we'll talk about the richness in the types of agreements that end up being struck between those two parties. And then we'll think carefully about what the financial implications of that are. And given those financial implications, we're going to be able to answer an additional question that we can't answer after just doing topic 3, which is topic 3 tells us how valuable the whole pie is. Topic 4, one of the things that'll help us try to understand is how is that value split across all stakeholders, right? Founders, employees, and all the different investors. And in order to do that, we'll introduce some option pricing techniques. Again, for some people, this tends to be a little bit scary. I will try to do it in a way that demystifies things a little bit. But let's not get ahead of ourselves. That's topic 4. We're not there yet. Let's focus on topic 3. Sound good? All right. I will start sharing my slides. Can everyone see my slides? All right, perfect. Yeah, quantitative decision-making part 1. There's actually going to be 3 sets of slides for topic 3. And we're just touching on the first one today. The 3 sets of slides, basically today, I'm going to introduce something called the VC method. And I'm going to try to think about what the VC method actually means and how this relates to the fair discount rate for valuing the cash flows of investments into startups. And I'm going to try to highlight what I think the big picture observations to get from our analysis today are at the end of the lecture, okay? But this is what we're going to do today, is we're going to introduce VC method, and then we're going to talk about what this method tells us in the context of discount rates. After we do that, then we're going to be ready to start talking about comps-based valuation and DCF-based valuation. These will be done over multiple lectures. Okay? Sound good to folks? All right, so let's just focus on what I call Module 10. That's basically today, okay? And I'm first going to introduce to you something called the VC method. And let me tell you what the VC method does. It's a super simplified way to try to come up with an estimate of the value of the whole startup, right? So that thing that I said that we're doing in topic 3, get the whole pie. It's a method that actual real world VCs use to answer that question. But in answering that question, they're taking a substantial shortcut, and I will highlight what the key shortcut is. That key shortcut is going to be addressed with all the hard work in the set of notes 2 and 3 for this topic. So that shortcut thing, I'm gonna point it out to you, but we're gonna shelve it for now and spend a lot of time talking about it later. Okay? Are we on the same page here? All right, so let me tell you what the VC, look, it's any model starts with inputs and provides you with an output via a mathematical formula, right? That's the definition of a model, I think. So what are the inputs in the VC method? So first of all, the objective is that it helps VCs determine a rough valuation of the startup and provides them with an ownership target. What I mean by an ownership target is it allows them to find out, if we do this deal, how much of the company must we be given at least? It will answer that question. Okay? So now let me explain the key inputs, right? To use the VC method, you need the following inputs. First input, average exit value if the startup succeeds. This will be denoted by V_T. This is our shortcut. Because if you're asking yourself, Jiro, how can we get this number? Your point is well taken. It takes some art and it takes some careful science to be able to even lay claim to the statement that we can figure this out. This is all the hard work that we will do both here and here, okay? But for now, let's just assume that we know it. It simplifies our discussion for this first part, okay? But what I want you to understand is it's about the exit value. It's about an average exit value, but it's an average exit value conditional on success. So this is something that should feel weird to you because you've probably never heard the word conditional on success when doing a DCF before, right? And so there's going to be practical reasons, and I'll talk about them at length later, for why we use that input, okay? There's actually going to be real, legit justifications for it. But again, I think in the interest of time, let's bypass that discussion to parts 2 and 3 of this topic, okay? But I just want to make sure that we understand that this is our input. What other inputs do we have in this model? Well, the anticipated average exit date, T. I mean, obviously that matters. A company is worth more if you expect it to exit for $1 billion in 1 year than if you expect it to exit for $1 billion in 100 years. So clearly this is an important input. When we think exit will occur is important for guiding our judgment of value. So far, so good? What else do we need to know? We need to know the size of the proposed investment by the VC, right? If I need to make an investment of $2 million, the amount of percentage equity in the company that I need to be given is definitely higher than if I only needed to invest 1 million. In fact, I'm willing to bet that that target equity has got to be at least twice as much because I'm investing twice as much. So that's clearly an input for getting our ownership target as well. What I'm just keeping going through the things. Number of shares outstanding in the startup before the new funding round. So you come to me and you say, Jiro, I want $1 million. One thing that when I want to decide how much shares you need to give me, the first thing I want to know is how many shares are already out there, right? I'll ask for a different number of shares if you tell me that there's only one other share in the company than if you tell me there's 1 trillion shares in the company, right? So also an important input specifically for the ownership target. Then finally, there's this weird number that I'm going to talk about, and this is my main goal for today, is to make sure that we understand what this number actually means, which is something called the VC discount rate. You will notice, oh, actually, you may not notice because I am now in a small picture, but pay attention to the small picture for a second because I'm going to say it again. VC discount rate. What I mean is it's not a real discount rate. And we will precisely try to understand why it is not, why it is different, okay? But I'm going to represent this by the parameter D as opposed to our standard parameter for a discount rate, remember, is R. Now, D is going to be related to R, but it's also going to be related to a bunch of other things, and it's going to be important to appreciate that, okay? But given these numbers, I'm just going to mechanically describe to you what the VC method is. The VC method is just something that looks a lot like taking a present value. Oh, exit value, again, caveat conditional on success, is VT. Let's discount it by the discount rate, D, for T periods, and we will call this the value of the company after the investment is made, which is also called a post-money valuation. There's also the concept of pre-money valuation, which is if you take post-money valuation and subtract the investment that's actually made, that number is your pre-money valuation. It's kind of like saying, well, before the investment, the company was worth this much. After the investment, it's gone up by the investment. I mean, this is a wishy-washy logical thing. I don't want to go down that rabbit hole. I'm just telling you what the practitioner definitions of these terms are, okay? Now, if this is the value of the whole company, well, the whole company is worth this much. The VC invested this much. They need to own at least this percentage of the company. Because if they own less than that, what they received is worth less than what they paid. And they were snickered. Let's assume that VCs don't want to be snickered. We okay with that? So theta 0 here. So this is the output. I'm giving you the outputs of the VC method. Output number 1 of the VC method is this. That is the value of the company after the investment. Output number 2 of the model is this. This is the target percentage that the VC must own in order to justify making this investment. So they cannot be given less than this, but they can be given more. They would be just happier, right? Now, here's a question. If you need to get at least this percent, and there are this many shares before you get yours, how many shares must you be given? The answer to that purely mathematical question is this formula right here. You must be given at least this many shares, given that everyone else owns this many shares, in order for you to get at least this percentage of the company. Now, this formula to a lot of people doesn't look obvious when you look at it, but all I'll say is, logically, this is a math proof. If you're given this much of the company, you own this percentage of the company. And I leave it as a nerdy exercise to anyone who's, paranoid about this stuff, to prove that the statement that I just told you is correct. I don't think it's worth our time for me to prove it here in real time, but it is a mathematical fact. So do we kind of have a handle of this model?
Jiro, I just have a question about the post-money valuation, the pre-money valuation. I'm just like, 'cause I know you said you didn't want to talk about it, but if you could just mention briefly, because here you're determining the exit value under the assumption that you have invested, and that's also factoring in the additional value as a VC you contribute to the company.
So Kanishk is 100% correct. This is the reason why I said wishy-washy, is that what Kanishk is saying is, wait a second, like the VC contributes more than just capital. So let's say they gave $1 million, but they're also adding another 200,000 in value because whatever, they understand the life cycle of startups. And so because of that, if the investment didn't happen, the company's not just worth 1 million less, it's worth like 1.2 million less. That's the point that Kanishk is making. And his point is 100% correct, right? So actually my biggest problem in the terminology is the terminology around pre-money valuation. That pre-money is the value of the company before an investment gets made, where Kanishk's point is well taken, that actually startups oftentimes get a good deal in the sense that what they give up is less than what they receive, because they receive funding and they receive whatever services, advice, access to a network, yada, yada, right? Kanishk, agree. I agree, right? I mean, the only time I would say that those two things are the same is if the market for VC investment is so competitive that VCs keep undercutting each other until they get what they pay for. In which case, then the two statements are one and the same. You see what I'm saying? But to me, this is kind of like, Kanishk is, I think, will take it the right way. He's a nerd a little bit like I'm a nerd. And so, like, yes, that's true. But we don't really need to fully hash that out to be able to know how to use this model, okay? But hopefully this model seems fair. Can I ask a favor? Can one of you guys open Excel so that I can ask you guys to plug things in Excel and you can tell me the numbers? All right? Because now what we're going to do, or in a second, I'm going to do this slide first. But after this slide, we'll actually use the VC method. And what you'll see is it's damn easy to use. That's why it's so popular, okay? But before I do that, I'm actually going to tell you more about the model, because you might wonder, where in the world does this D come from? And where does this T come from? Right? Because I was telling you, like, this is the main thing we need to figure out later on. But you might be like, well, wait a second, I need to figure this out, and I need to figure this out, right? Well, there's actually surprisingly uniform rule of thumb guidance on what numbers to use for D and what numbers to use for T, so that you can literally use these numbers in the real world, and it's in line with what real world VCs are going to use, which is that most VCs, for a very early stage investment, seed stage, for instance, or even pre-seed that we talked about in our life cycle of funding, they'll use a value for D of 80% or more per year. For a Series A, the value of D that will be used will be in the neighborhood of 60%. Series B, 50%, Series C, 40%, and then we gradually fall beyond that. Now, I'm seeing some faces here, and it sounds like you guys are like, what now? that sounds high. I keep getting told by Damodaran to use a discount rate of 9%. But remember, discount rate. It's not a discount rate. And what part of what we'll try to get by the end of this lecture is that those things are not the same. And we'll be able to reconcile real discount rates with this practical and make your life easier VC discount rate. Sound good? In terms of average time to exit, seed stage or earlier, traditionally it's been 6 or more years. Series A, 5 years, then going down by about a year per round. Okay? Look, I mean, these are the numbers that are in line with historical data. You know, these numbers change a bit over time, and we did talk about the stretching of the life cycle, the funding life cycle. I think at some point in topic 1, if I recall. And so it might be that these numbers will change in terms of rule of thumb guidance in the future. So you should just pay attention to that. But throughout this topic, when we do examples, and we're going to do examples, at least with comps valuation, we're going to do it with real world stuff. Okay. And whenever we're doing real world stuff, we are actually going to use these numbers. Okay. And my view is you use those numbers, you're actually doing a sensible real world job at things. Okay. So now let's go and apply the VC method with a simple example that is meant to illustrate just how easy using this set of formulas is when you assume that you already know this number. So that all the hard work in the VC method is about figuring out this number, which again, let me repeat, is what we will do in part 2 and part 3 of this topic, not part 1 that we're doing today.
Jiro?
Yep.
This might be like something you kind of said a couple of minutes ago, where at the bottom there, you have like percentage ownership that the startup or the VC must have if they're making an investment of I0. Does that assume, like you said, VT is EV, but in reality, like most startups don't have debt, so it's probably closer to equity value.
Yeah.
Wouldn't that, like, if you were to actually have EV, you wouldn't include debt in calculating how much an investor in equity?
Yeah. So actually, you know, I should clarify. So thanks for asking the question. In all of my calculations and everything I'm going to do here, I'm actually effectively going to be assuming that I'll be effectively assuming that the company has no debt.
Okay.
So that you don't need to subtract the value of debt from this whole thing and take a percentage of that.
Okay. Yeah. Perfect.
To a first order extent, this is a pretty good description of most real world startups, especially in the early stage. Folks okay with this?
Thank you.
I just have one question. I can ask it later if you want, but it's about the like definition of Series A, B, C, because it's like when we learned about it, it's a range, and then if you're saying there's a set value based on a categorization.
Yeah. Okay, that's also a good question. I mean, you don't literally interpret the labels here, right? So, you know, remember I gave an example early in the semester where I said, well, Lightspeed point of sale, when they raised their Series A, they were not a typical Series A. They were more like a typical Series C because they already had go-to-market fit, right? So if you're valuing Lightspeed point of sale, even though they're technically called a Series A, you would not use this number. You would use this number, right? So you don't interpret my labels here literally. You interpret it as is the company more like a standard Series A or is it more like a standard Series C? So you have to make that judgment call. So absolutely 100%, like that's true. And it's important not to forget that. So I'm happy you brought it up. Folks okay with this? All right, well, let's do our example. And this is hopefully going to illustrate really the fundamental appeal of using the VC method is that it makes everything after getting this number, which is the real hard work, it makes everything else relatively smooth and simple. So let's take an example. We've got a VC firm called Mission Ventures. And Mission Ventures is considering making a, let's be clear, typical Series B investment in a startup, let's call it iHealth. The required investment into that startup is $10 million. And the VC, MV, Mission Ventures, it estimates that the terminal value, let's be clear, this is the exit value, like at what valuation would the company have an IPO or be acquired. Its average value at exit, and we expect exit in 4 years, where 4 years comes from Series B, 4 years, right? We expect that that would be, on average, conditional on success, $125 million. The VC discount rate for a typical Series B is, let's go back to the rule of thumb, 50%. So D is 0.5, T is 4, V underscore T is 125 million. And we'll also assume that the number of shares before we invest is 2 million. So there's going to be more than $2 million after we invest because we're going to be given shares too. Those are going to be brand new shares that did not exist before. Now the question is, what ownership of the firm must MV be given in order to invest? That's the theta zero if we express it in percentage terms. And then I also asked how many new shares must be issued and given to MV. That's the delta X0. Whoops. That's the delta X0. And X0 is 2 million, as I said. Folks okay with this? Well, this is just plug and chug. It's not even that much chugging, right? Because someone can open up Excel for me to get post-money valuation, 125 million divided by 1 plus 0.5 to the power of 4. Can someone just calculate that for me?
24.7.
So 20, that gives us this number here. When you plug the numbers, it's 24.7 million. Now, take the investment, 10 million, divided by the 24.7. What
41%.
number does that? How much?
40.5.
41%.
Let's call it 41%, right? That means the VC, in order to justify that investment, needs to be given at least 41% of the company. If they're offered 35, it's a bad deal. They say no. If they're offered 43, UP, you know, they're getting a little bit of extra value, right? So I just want to make sure that we understand how to interpret these numbers. Make sense so far? Then the final question is, how many new shares do you need? Well, that would be 2 million times 41% divided by 1 minus 41%. That is equal to how much?
1.36 million.
1.36 million shares. And indeed, if you don't believe me and you're worried that I'm full of crap, do the following calculation. You own 1.36 million shares. There are a total now of 2 plus 1.36 million shares, i.e. 3.36 million shares. Calculate 1.36 divided by 3.36, and you're going to get 41%. You want to confirm that that statement is true, Kanish?
Yeah, it's true.
It's true, yes. So it's math, okay? So that's the VC method, people. And that's why it's so commonly used by VCs, is this was not difficult. The real question is, how in the world do we get this, okay? So far, so good?
Just Jiro, as a quick thing, like,
Mhm.
to what extent is a VC basing, like what level of investment would they base off of a back of the envelope calculation like that?
What do you mean? By the way, this is not as back of the envelope as you think, because if you do this really well, this is a rigorous model. And
Right.
it's actually, by the way, let me be clear. We're also going to understand today that what seems like a dinky value for D that's kind of picked randomly out of thin air and seems outrageously big, the one thing that I want you guys to get out of today's lecture beyond understanding how to use this model is just how sensible the rule of thumb numbers for D are, and just how much complexity is hidden inside this innocent looking number. So I think what you're saying is this looks pretty cheap. I wouldn't want to invest a lot of money on the basis of this thing that looks like a back of the envelope calculation. And what I hope to convince you of, partially today, but even more so by the end of this topic as a whole, is that this is not as dinky as it looks. And it, by the way, it took me a while to appreciate that, because when I first saw the VC method, my reaction was exactly the same as yours. I was like, what the fuck? Okay. I'm like, that's like finance for mental midgets. And it was only after I thought about it much more carefully, and everything that I'm covering in lecture today, and actually the rest of the week, it's stuff that I kind of developed on my own with the help of some of my practitioner friends, that made me realize, like, this is more sophisticated. There's more than meets the eye on this thing. So you feeling that way, totally get it. I was there once. Okay. It's actually surprising. It's like remarkable to me how much complexity is reasonably hidden in the simplicity of this model. It actually kind of blows me away. And you guys don't have the basis to have that opinion yet, but I hope to convince you guys that that's a little bit true. Okay? Now, one of the reasons this seems so damn dinky to the current version of Mike, but also the former version of myself, is that these numbers look like such a cartoon that you can't take things seriously. Would we agree with that statement? Because most VCs, by the way, don't call it a discount rate. They actually call it a discount rate. And that confuses people and makes things look wrong. Because if this is an actual discount rate, holy cow, sign me up, right? Like, and the first thing I want to do is convince you guys that there is no way that this is actually a discount rate. Because if this was actually a discount rate, and this was how VCs valued their investments, early stage VCs would earn an average return of what? 60%, right? That's the definition of a discount rate. It's the expected return on your investment. So if this was a discount rate, you would look at the whole universe of Series A early stage funds, and they would have an average return of 60% per year. Let me show you what the data actually shows you. So I have some data here that I obtained from, I think I obtained it from, I even state it in my slides. Because of the Freedom of Information Act, pension funds are required to disclose a lot of things to the public. One of the things that they need to do in the US, so the, like state pension funds and pension funds associated with university endowments, is that they're required to disclose the performance of the investment managers they hire to manage their money, including the VC funds that they put money in. So I went and took advantage of that and looked at those reports to see, for the University of California system, the VC funds that they invest in, how well do those funds usually do on average when you look at their historical performance? And this is just a subset of the funds that they disclose. I don't remember when I got this data. It would have been a couple of years ago, you know, two to 4 years ago. This is it's not exactly it, but this is loosely speaking the average rate of return on different funds. Kleiner Perkins, their 7th fund. Kleiner Perkins, their 8th fund. Kleiner Perkins, their 9th fund. Sequoia's 9th fund. Sequoia's 10th fund. These were all investments that they made. And these are the returns that they'd earn over the life of the fund so far. Some of the funds are finished, so that's the official final return on an annualized basis. Look, we can see some pretty huge numbers. Not bad. Wish I invested in that fund. But the two numbers are giving you a misleading perspective because you can see a lot of variation. Yeah, I actually took the average of the performance of all the funds that University of California invested in over a 20-something year period, and that average was less than 15%. These are, for the most part in this list, early stage funds. So just to go ahead, yeah.
Could you just mention what vintage means, please?
Oh yes, thank you. Vintage means the year that fund was launched. So this was a fund that was launched in 1994 because the University of California system needs to disclose not just what they own right now, they're disclosing everything that they owned in the past. So this fund it's dead, as in it's reached its end of life, it's fully paid out, right? But, you know, if you do the IRR of the cash flows on that fund, it was 121. The realized IRR was 121% per year. Nice. You know,
Jiro,
yes.
So when you say that's the year the fund was launched, is that the year the fund started raising capital or the first year it deployed capital?
It's the, it might not be exactly the first. I mean, I'm pretty sure it's when it launched. It's when they secured all the commitments, and almost surely they made their first investment in that same year. So it's the year they made the first investment. Look, for something like Sequoia, they decide they want to raise a fund. They basically have the commitments lined up in a week, right? But like, you know, for some other less well-known venture funds, it would be when they secured all their commitments. Sound good?
Got it.
Yeah, but that's what vintage means. It's like the year that the thing started, the fund started, as in it was raised and good to go. Right? But here's the big picture thing that I want us to get out of this data. The average performance over the life of the funds is it's less than 15%. Let's call it 14%. Right? Well, that's the best approximation I can come up with for a true discount rate. So now this starts to sound even more fishy, right? Because we're like 14%, and then we look at this table, we see 60%. Well, actually, you might be like, Jiro, you just made me more confused, not less confused, correct? Because that seems to be strikingly different. And what I'm going to do is I'm going to reconcile those two numbers for you. I'm going to show you that a 14% real discount rate, along with some other observations about the venture business, is going to get us to a VC discount rate of about 60%, which is actually remarkable to me, to be honest, because I never expected to get these things mapping out that nicely when I first started thinking about this carefully. I thought when I was looking into the VC method that I would come up with a bunch of criticisms of the VC method and why no one should ever use it. And I ended up like changing my mind in the process of this exercise. Okay. Because at this stage, it looks even more disconnected, right? But I'm going to try, my goal for the rest of today's lecture is to reconnect those two things, a 14% discount rate and a 60% VC discount rate. Sound good? In order to do that, I need to build a model of valuation for a company that is a little bit more rigorous than the VC method. And in order to do this, I need to think about valuing the startup from a bit more of a first principles standpoint. And this is going to require me to add additional parameters that we know are relevant that were completely missing from this model. Because remember, notice here we said VT, but conditional on success, right? Well, it seems to me the probability of success is probably important in determining what the value of a company is. Would we agree with that statement? So I will now introduce a new parameter. P, probability of success. 1 minus P, probability of failure. I will also assume that if the startup fails, it's a big fat donut. It pays out 0. Right? So with probability P, the project pays out VT. With probability 1 minus P, it pays out 0. So I'm making a more rigorous model, but I'm not making the most rigorous model possible. I'm actually trying to build the simplest version of a rigorous model right now. So far, so good? What else? Other things that are going to matter in my model. Expected future dilution. If I invest in you right now and I get 40%, I don't expect to own 40% when the company exits. Because when the company exits, it will have raised other rounds of funding before its exit, which are going to dilute my position. So if I expect 50% dilution and I own 40% right now, it means I actually only expect to own 20%, which is 1 minus 50% of my original 40% when the company exits. Does that make sense? So we need to take a stand on expected future dilution to be able to guess what the value of our shares today are. What else? We also need to factor in fees charged by the venture fund. This is our context. The investment is being made by a VC. The VC is investing other people's money. These other people are called limited partners. And the limited partners don't get all the payoff that results from the investment because the VC firm, the general partner, will charge fees to them. They will charge an annual management fee, and they will charge something called a carry fee, which is a percentage of the gains that are realized from the investment. So that if you invest 10 million and then the thing returns 20 million, there's a $10 million gain. That $10 million gain will be split between the GP, who are the VCs themselves, and the LPs, the people who actually originally gave the money. A percentage C is kept by the VC. The remaining percentage 1 minus C is what actually goes to the LPs. So a percentage 1 minus C of the, let me be clear, gains. In terms of the baseline return, right, getting your principal investment back, right, the LP gets 100% of that until there are gains to be split. And then another thing that matters is the actual real discount rate, the correct, true parameter R that we've seen in every NPV formula we've ever looked at. Are we okay with this? These are going to be the parameters of our model. Now, the thing that maybe makes the least sense to you guys right now, especially because we skipped the part of the course that was about venture firms and venture funds, is that you may not know how this should be incorporated into formulas. So I will explain that in the next slide. And after I explain that in the next slide, we will build a model incorporating all these parameters and the parameter V underscore T, which was exit value conditional on success. Okay? But first, let's talk about these fees. So fees charged by general partners to the limited partners of its fund. There is a management fee. That is a percentage fee on capital invested or committed that is charged annually. Can be charged upfront or gradually, usually starts at roughly 2% and may fall after the fund's planned investment period ends. Look, usually venture funds have a certain lifespan. It's typically 10 years, but usually the goal is to invest the entire fund within 5 years. And so after 5 years, the VC might say, well, since we're done making new investments, we don't have as many fees, so we will charge you fewer fees. That happens sometimes. So there's a bunch of details here that can vary from fund to fund. As I said, I'm building the simplest model. So I'm going to build the simplest model in this manner. I'm going to assume the fee is charged up front, and I'm going to assume that the fee stays constant over the whole life of the investment. Put differently, what does that mean? Well, if the startup wants to get $10 million from the GPs, from the venture fund, the GPs are going to ask the LPs for more than $10 million. How much more? M times T, where T is the expected lifespan of the investment and M is the annual percentage fee. What they're saying is the following. We will invest $10 million. We expect this investment to last 4 years. We charge a 2% management fee per year on dollars invested. So 4 years times 2% is 8%. So take 100% plus 8%, that's 108%. So they will ask the LPs, give me 108% of what we are about to send to the startup. So they won't ask for 10 million, they will ask for 10.8 million. So far, so good? Again, this exact formula will differ from fund to fund, but mostly based on details. Is it upfront or gradual? Is this fee constant or not? This is just the simplest version of the formula. The formula can change in the real world, but it doesn't move the needle dramatically. So this is a pretty good cartoon. Are we okay? Now, what I need to address, and this is more challenging, I need to address how the carry fee impacts valuation. Now, what is the carry fee? It's a percentage fee on gross profits returned to the LP. For instance, if a fund raises $100 million and returns $300 million, there has been a $200 million gain. And that $200 million gain gets split between the LP through a carry fee, 200 million times C. Most VC funds charge a 20% carry. So 20% of the $200 million gain is 40 million. That would be kept by the GP. What would be left to the LP? They get 80% of this gain, which is 160 million, plus their original 100 million. So they would receive 260 million. Does that make sense to all? If you understand this calculation, there is a formula that we can jot down. And if you don't mind, I'm not going to bother to prove it here either. But again, if someone really wants to know it, I'm able to prove it. So we can schedule a Zoom thingy and I'll prove it to you there. Okay. But I don't,
Jiro,
go ahead.
just a quick question. To be clear, the 300 is net of the initial investment. So the total return is 400, right? That's what you said when you calculated the return.
No. When I say return, it's a gross return. It's a net, not a net return.
Okay, so then the return is 300, and then 20% of that goes to the.
No. 20%, like literally, like the VC took 100 million, sent it to the startup, and then the startup sent back 300 million. Out of that 300 million, all of the first 100 million, they return to the investor, the LP. The remaining 200, they split it 80-20.
Okay, got it.
Yeah, good stuff. So in nerdy math, one way to think about this is the carry fee reduces the effective percentage in the company that the LP owns. Because the VC gets 40%, but some of that 40% they keep from them for themselves through the carry fee. What is the effective percentage? The whole, collectively, the GP and the LP get this percentage. But out of that percentage, it turns out that the LP only keeps 1 minus C times this whole expression here, which is 1 plus RF to the power of T minus 1 over 1 plus RF to the power of T. By the way, RF here is not the riskless rate. RF here is the average rate of return on the fund's investments. Right? RF is the fund's expected return. And so if you do this calculation, maybe it would be like this number here is always an interesting number to me. Right? So like, we'll do an example where we calculate this in part 2 and well, actually we'll do an example. We'll do an example in this lecture even. So if you don't mind, I'll defer doing the calculation with actual numbers to a little bit later, if that's okay. But what this means is, you know, the VC fund gets their 40%, but actually maybe only 36% of that goes to the actual LP. Right? So they shouldn't price it like they get 40%. They should price it like they get 36%. Does that make sense so far? All right. Given these observations, we can now build our model that reconciles the VC method with proper valuation. And let me explain what I mean. Everything I'm doing here should feel like our hopefully semi-well understood NPV. Here's what I'm saying. This is an NPV calculation. It's NPV of the entire company. What is the entire company right now worth? Well, remember, what is NPV? It's expected cash flow divided by 1 plus R to the power of T, correct? That's the present value of a single cash flow divided by 1 plus R to the power of T. Got it. We understand this. This is just the expected cash flow to the current investors as a whole at exit. Why? Because the average exit payoff is what? Well, with probability P, we get this. With probability 1 minus P, we get 0. So that just vanishes. This is the expected value of the entire pie at time T. But current owners won't get that whole pie because of dilution. They will only get this fraction of the pie because delta was our dilution. If everyone right now gets diluted 40% in the future, we only have 60% of the future pie. Does that make sense so far? This is the value of the whole company right now. Now let's think about this from the perspective of the person who actually pays for this whole economic endeavor, which is the LP. It better be the case that the LP breaks even. Because if they receive less than what they pay for, this is not a viable economic model, right? So now let's think about this model. The whole company is worth this, right? Let's think about the economics of the limited partner. The limited partner, as we said here, owns this effective percentage of the company. So they own this percentage of this. So this is what they receive. They receive this number. What do they pay for that? They pay this. So if we take this whole number here, value of the whole pie to people right now, times the LP's effective percentage, and we subtract what they pay for this, which is this number here, that difference is what? It is the NPV of their investment, right? But notice there is a nuance here. It is the NPV of the investment from the perspective of the limited partner. I can also write the value of what the GP gets. The GP, right, whatever percentage the LP does not get, which is this, is actually going to the GP. That's their fee. That's their carry fee. So the GP gets this value from the carry fee, but they also get a management fee. So they also get this number. So the value of the deal from the GP's perspective is actually given by Formula 5 here. Notice this number is always positive. This highlights, by the way, a fundamental tension in delegated investment management is if you're a person who is managing other people's money, you only get the nice side of a carry fee and you get management fees. For you, it's a pretty safe business, at least when we think of it myopically. You can't lose. It's like heads we win, tails you lose, sucker, right? That could be a problem. Right? So this highlights actually something important as well. This is a little detour for a moment. It highlights the fact that whenever we're thinking of delegating our money to someone else, an investment manager, be it a VC, be it a hedge fund, yada, yada, we always need to be a little bit worried that the person will do the right thing with our money, because they might want to invest in stuff that isn't good for us because it's good for them. By the way, I'm not worried about this problem in the real world. There's a reason why I'm not worried about it, at least in VC, is because there's a reason why a VC isn't going to do this. They know that if they screw with people's money in this fund, they will have a difficulty raising their next fund. That's actually one of the fundamental economic reasons for why VC funds are not structured as evergreen funds that last forever, but are structured as finite life funds so that they are required to come back and ask for more money in the future. It disciplines them from this problem. Anyway, that was a bit of a detour. Now I'm going to go back on the main road and go back to talking about what this tells us about valuation. Are we okay with this? So now we look at this. This number, as I said, has to be greater or equal to 0. That just translates into this equation. This equation is mathematically identical to this greater or equal to 0. Are we okay so far? And if I rewrite this equation, it gives me a threshold for theta 0. So if theta 0 is given by equation 7 here, this is exactly equal. Right? Switch this to an equal sign. and then just divide both sides of equation by this number, and you get this expression. Is that okay? This is giving us a new formula for our ownership target. So this is the, whatever, if you want to call it the Jiro formula, you can call it the Jiro formula, okay? But you can also call it the annoying nerd formula. Formula 1. And then we have the formula from the VC method, this, where this is given by this. If the VC method is correct, it better be that the nerdy professor formula is exactly the same as the VC method formula, correct? Well, this is the VC method formula for the right-hand side of this expression, and this is my nerdy formula. I set them equal to each other. If those two things are equal, both models are correct. Notice VT, VT, those two things cancel out. I0, I0, those two things cancel out. And then I'm just left with 1 plus d to the power of t, and this number here is everything that was left here. This gives us, I put it in blue for a reason, this is a formula that reconciles the VC method with our valuation model. Now, why do I think this formula is cool? Well, you know, unfortunately, most people look at this and they think it looks messy. Fine, it's messy, but here's what it tells me. It tells me what D actually means. It tells me that the VC discount rate picks up the real discount rate, but it also incorporates a bunch of other information: expected future dilution, probability of success, and fees. So that it is an amalgamation of many different things, which is why the final number for this looks so weird. And when it's quoted, 60%, you're like, what? It's because 60% is not 60%. It's like this weird Google Translate that goes from like human language to whatever. I don't know where to pursue that one. Right? This is telling you what the VC discount rate actually means. Plainer English, D incorporates more than just the proper discount rate R. It also incorporates amount of time till exit, because T shows up everywhere here, probability of success, expected future dilution, annual management fee, and carry fee. It is literally, it is not a single ingredient. It is like a mole. You know, if you are into like Mexican food, like mole is like this famous thing. Like they put 20 ingredients and it fucking tastes so good, right? This is like the mole of finance, okay? Right? And that's important because now when you look at 60%, you're not thinking about paprika. You're thinking about mole, okay? Mole not equal to paprika, right? So, yeah. So let's see. I'm trying to think about time here. You know what? It's 5:30. I've been up since 3 a.m. because I had meetings with students in China early today to kind of fit to their schedule. So what I'll do, this is a natural break point. I will stop it here today, and I'll continue this discussion in our beginning of next class, and I'll kind of figure out like if this requires some streamlining of some other stuff later on. But this is just a natural point because actually, even though we haven't done a lot of complicated math here, it is actually useful to dwell on this form. Like, I'm kind of happy that I derived this formula, even though it's so basic, because it says something that is so fundamental. And that, exactly as Mike says, this is the key to unlocking the confusion. Because you looked at D and you're like, there's no way it's R. And now we have a model that says, yes, Mike, you're right. It's a bunch of stuff. And what I'm going to do next lecture, at the beginning of lecture, is I'm going to show you that the rule of thumb value of D actually picks up really realistic numbers for all of this. So that it's like this like pretty like amazing thing where like what seems like a pretty hand-wavy set of numbers by VCs seems to actually be carefully calibrated to the history of VC investment when you look at the data. And that's what I'll talk about at the beginning of next lecture. Sound good? Again, if this doesn't all totally make sense, it's actually sensible. Because actually, this is one of these things that until you really wrap your mind around it, it seems a little bit tough to grasp. But I think it's one of these things that once you grasp it, you're like, oh, wow, like this is pretty fundamental. It's not that complicated when you really wrap your mind around it the right way. And it addresses a lot of confusion and actually makes you realize that VCs may be more sophisticated than they actually look. And it gives you comfort to use something that seemed almost too simple at first glance. So like actually, Mike, I am actually extremely happy that you asked that question, because the whole point of this exercise was to either make or break that practice. And the thing that surprised me is that when I did this exercise, I didn't break it. I felt actually like it was surprisingly good. All right. And we will continue making that point at the beginning of next lecture. Sound good? All right. I think we're good then. Have a good day, evening, or whatever, everyone.
Go ahead. I don't want to keep you, but I just want to quickly ask, if I can, one quick question. So what I was trying to get at earlier was, like, what sort of investments is a VC basing this calculation off? Like, if are they going to invest solely based off of what this calculation says, or are they going to do more detailed?
No. So first of all VCs, and in fact, if you go and look at the Mia and Alex interview, they actually explicitly said this. The valuation is one data point, and they look at a bunch of other things, qualitative things, some that are more gut, some that are more logic, right? So this is just one thing. VCs will never, ever, ever, ever solely rely on this valuation, for sure.
No, 100%. I completely agree. I guess what I was saying is, with that valuation data point, with valuation just being one data point, do they get that data point using this method? Like, is that like,
look, I mean, you're going to see some variation among almost all VCs will use the VC method. Whether they use like a D of 60% or 65% might vary from VC to VC. But the thing that shocked me when I was first surveying all the VCs I could get in touch with through my network was just how consistent the numbers were across different people. The only thing that seemed to make a difference on which number they would use was whether it was early stage or late stage, right? Like if it was early stage, remarkable. Like if you were a fund that invests in consumer internet versus a fund that invests in enterprise SaaS, like you still tended to use pretty much the same numbers. That blew my mind. But like I've looked at a bunch of data and I'm not able to come up with a strong case for why they shouldn't do that. I mean, I'm not going to touch on everything I've looked at in this course because we don't have time. But like, to me, it was surprising, but I kind of am on board with it now. Not I am bored with it. I mean, I am on board with it.
Yeah, for sure.
I mean, but like, I know, like, you're a pretty rigorous thinker. So to you, it just seems unnatural that this could be true. I get it. I felt the 100% same way.
Yeah, I think it's just gonna take. I want to spend some time going through exactly what I want to go through it again, and just like a couple of times go through the slides we went through today, and just really appreciate, I guess, the complexity that actually is behind the model.
Yeah, and there's more complexity to discuss that I haven't had the chance to discuss today, which is I'm going to show you real world data to give you a sense of historically what's the value of P, probability of success, historically. What's the value of expected future dilution? And when I plug in those numbers, we are going to get like some insights about the fair discount rate for VC that are going to be like surprisingly in line with real world data, which just knocks my socks off.
It just seems like such a not why, I guess maybe why I'm initially like kind of feeling this way is I feel like it's not a uniform industry. Like, I feel like there's so much variation throughout that it's just
like your gut is totally in line with reasonable logic. It's just that, like, look, none of this is perfect. Let's not kid ourselves. That's why valuation is only one data point, right? It's just that, like, the differences between different industries seem to be insufficiently large for us to pretend that we can carefully calibrate it across different opportunities. The only variation that seems to matter in a material way for practical calculation is not within early stage healthcare versus consumer internet. It's more early stage versus mid stage versus late stage. That's where the real action happens. Because early stage, you're more risky. You have a higher discount rate. Mid stage, a little bit less risky. Late stage, you start to look a little bit like a public company. And that seems to be the thing, to me, that matters the most. And what we will see is that's what VCs are effectively hanging their hat on and focusing on when they're using those rule of thumb value of D. It's there's like an elegant parsimony to it. Like, I don't think the VCs did these calculations in their head, but like, I'll give you an analogy, okay? It's like, look, if you want to be an awesome poker player, right? Like, so I have a couple of friends that are professional poker players. And one of them was like the World Poker Tour Player of the Year in 2006, right?
Oh.
And I've talked to some of these folks about this, and there's two types of professional poker players. There's very analytical professional poker players that literally run math simulations. They usually have a technical background. Maybe they did a master's degree or a PhD in computer science or in math or something like that. And they like do it all on the basis of rules. And they can tell you exactly why they do what they do. That's one type. There's another type that literally acts as though they were that kind of math genius, but it's all in the gut. And it's not just like random gut that was given to them by God. It's because they've played so many times that over time, their intuition has developed and calibrated into almost being as though they understood the math. I mean, let's think of it another way. When you shoot a free throw in basketball, there's some serious physics going on in there. Every time Michael Jordan shoots a free throw, I guarantee you he's not thinking of Newton's laws. He's not doing that math. He's not taking trigonometry meets 3 rules of fundamental finite physics when we're not operating in quantum scale. No, he's just gotten the muscle memory. And the muscle memory makes him act as though he knew those laws, right? That's the way I think of VCs. They've got so much muscle memory around that they end up acting as though they did that model that I presented, even though if I presented them that model, they would pat me on the back and say, okay, Jiro, go back to your little dungeon office in Bronfman where you are all alone these days, and call me in a year. That's what they would say, right? So I'm not telling you that that's what they do. I'm just telling you, like, I see what they do and I'm able to rationalize it. And my reconciliation of it all is this muscle memory argument that you act as though you know all that stuff because you've done it so much and you've managed to survive. So you must be doing it kind of right. And to me, like, the best analogy I can think of is the analogy that I got from these poker players. So yeah.
Awesome. Thank you so much. I appreciate that additional, insight and explanation.
No problem. All right. Have a good one.
Have a good day.
Take care. Bye.